SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to today's SUERF-Baffi Bocconi e-lecture on challenges from low growth and diverging price and cost developments, key takeaways from the European Commission's 2025 Alert Mechanism Report. The Alert Mechanism Report is an annual report in which the European Commission monitors economic imbalances to identify them early on. The report offers an economic and financial assessment based on a comprehensive set of macroeconomic indicators. The latest report, published in December 2024, focused on the heterogeneous implications of the fading inflationary pressures across the EU. Elevated recent inflation alleviated private and public debt ratios, but future developments will likely be more challenging due to less favorable growth interest rate differentials. A fallout from the inflation episode are increased divergences in costs and prices across EU member states, which affect both intra-Union and external competitiveness. Rising geopolitical fragmentation and escalating trade conflicts pose serious challenges for EU member states' globally integrated and export-oriented economies. Going forward, huge demands on public spending for defense, climate, aging, and the digital and AI transformation may further strain fiscal sustainability. Rising competition for savings has turned the former savings glut into what Isabel Schnabel called a bond glut recently, putting upward pressure on nominal financing costs, while the additional demand generated by increased public spending may, combined with a bundle of negative supply shocks, put upward pressure on prices and complicate central banks' tasks. We are happy and privileged to discuss these issues today with a group of excellent experts. First, may I welcome warmly Christine Frayne, Head of Unit at DG ECFIN of the European Commission, who is responsible for the Alert Mechanism Report. Following Christine's presentation, two top experts on the European economy will offer their comments and additional observations. Please welcome Ralf Setzer, Senior Team Lead Economist from the ECB's Supply Side Labor and Surveillance Division, DG Economics, and Sylvain Broyer, Chief EMEA Economist at Standard & Poor's Global Ratings Europe. Without further ado, dear Christine, over to you.
Thank you very much. What I'm going to do is I'm going to give you kind of the main overview of our Alert Mechanism Report. And this is a report that we do every year under the macroeconomic imbalance procedure. So first of all, what is the macroeconomic imbalance procedure? It was set up in 2011 in order to fill a gap that existed in EU economic surveillance. So the Stability and Growth Pact had been there since, I think it was 1992. And so clearly, the EU was very focused on fiscal and looking at fiscal risks. But it was evident when the crisis happened, around 2008, that we hadn't been monitoring the macroeconomy sufficiently beyond the fiscal. And so this procedure was set up in order to fill the gap. The way it works is that every autumn, winter, depends, we have an alert mechanism report, which is a report that's based on an economic reading of a scoreboard of indicators. And essentially, it does kind of two things. It looks at the developments and evolution of imbalances and what's been happening globally globally is kind of the wrong word in terms of geography, but what's been happening overall in the EU economies. And it selects countries that stand out as being at risk of having economic imbalances. And when those countries are selected, the next step is that they will have an in-depth review. These are typically published in the spring. And the in-depth review provides a country-specific analysis that looks at whether a country has imbalances or excessive imbalances. They're defined essentially as trends that give rise to macro developments which adversely affect or have the potential to adverse affect the proper functioning of a country, monetary union, or the union. So we have a country specific, they're country specific, but we do look at the impact that they can have on the union or the euro area as a whole. So this is kind of what we did in the autumn. So what I'm going to take you through is both the developments and kind of the overall story, and then at the end focus on kind of the one country that we picked out as having an IDR and in-depth review. And when I say one country, the one thing that is maybe a bit particular about our procedure is that if a country is assessed as having imbalances or excessive imbalances, it will continue to have an in-depth review every year until the decision is made that it no longer has these imbalances. So essentially, we have kind of legacy countries that we continue looking at every year, and then each year we may or may not select one or more countries that are kind of new to the procedure. Now, over the years, so this is a table you don't need to spend you don't need to look at kind of all the details, but it shows you since the beginning of the macroeconomic imbalance procedure, which countries were found to have imbalances in blue, excessive imbalances in yellow, were assessed to see whether they had imbalances but were found not to in green, or were not kind of subject to any, let's call it a risk assessment under our procedure. And the reason I put this up there is kind of to show you two things. So if you go further back in time, what you can find is that there were more and more countries that were subject to this procedure. So you go back to 2015, we had 15 countries for whom we did IDRs. If you go back to last year's procedure, well, by the end of it, so it's the right-hand column, we had 9 countries that we found to have imbalances or excessive imbalances. So what essentially has been happening is that when this procedure was set up, it was very much focused on debt stocks and the unwinding of the previous crisis. And then kind of over the years, we saw that this became less of an issue as more and more countries had reductions in their debt levels. And instead, what we've had kind of very recently is additions, so new countries, and specifically Hungary, Slovakia, and kind of an upgrading of Romania that have been added in, which are countries that display kind of new trends or trends that relate to price cost pressures, to external vulnerabilities, and specifically in these cases, maybe to bad fiscal management, but which is not manifested in debt levels, but rather in deficits. So essentially where we are now and where we were at the beginning of the writing of the report, and this kind of is the context to look at the various elements that we focused on, is a sort of legacy of countries that very much have kind of high debt, specifically on the government side, and that may be linked, although not in every case, to external weaknesses. And this is kind of Greece, Cyprus, and Italy. We have 3 countries kind of still in the procedure, which have some combination broadly of high private debt, which might be linked to housing markets, and or current account surpluses. And so this is kind of the Netherlands, Sweden, and Germany. It's a bit of a kind of gross putting together of countries, but anyway, it gives a broad sense. And then we had kind of Hungary, Slovakia, and Romania. So with this background, what we did is kind of we analyzed the various sectors of the economies in order to look at the broad picture that relates to the kind of imbalances that have been there over the years and the vulnerabilities, and to determine whether there are new ones that should concern us. So first of all, we looked at kind of the external sector and competitiveness. Now, what you'll see in my slides is that there's a lot of kind of reference to 2023. The reason is that at the time of writing the report, and kind of even now, that was the year for which we had full Eurostat data. So we do then analyze it within the context at the time of in-year data and nowcast for 2024 and forecasts. But in terms of the kind of the statements about what's happened and the fact that we base on our analysis on the scoreboard, it relates to 2023. So at the time when we wrote the report, a kind of key development on the external side had been that current account balances had increased in most EU countries in 2023. This is kind of particularly significant because there had been a sharp fall in most current account balances with the energy crisis. And so 2023, we have the moderation of energy prices, but also weak domestic demand, which are the key contributors to an increase in current account balances in most countries. Now, some large deficits that had been there before remain, and significantly, what's important is that in a number of countries that have current account deficits, we have ended up sort of post-pandemic. So when we kind of compare what happens on the external side, or what the situation is on the external side compared with 2019, we have an increase in deficits relative to the 2019 level, particularly for some countries that are net debtors on the external side and that had deficits before. We also are concerned in the macroeconomic imbalance procedure by surplus countries, and high surpluses on the whole persisted too. Now, in terms of the euro area overall, what we found was that we had a return, and I'll show you this in the next slide, of the euro area current account surplus, which had fallen down. It's back to around, it was back to around 2%, which was slightly higher again than the pre-pandemic level, but exceeds a level that is implied by fundamentals. So as part of our analysis, we have current account kind of norms and that are based on fundamentals. So we estimate these. The IMF does this too. They have different ones. But nevertheless, the story is broadly the same, which is that the euro area current account is higher than what would be applied by the fundamentals of its economy. And of course, now when we look at, which, okay, it's not something that we dealt with at the time, but when we look at the whole kind of discussion around tariffs and the US, this is something that is kind of relevant in terms of the discussion, at least as it's framed by Donald Trump. Now, in terms of kind of stock positions, of course, 2023 was a year when we had very high nominal growth, and this has contributed overall to a broad increase in net external positions. So what we have is essentially a one-sided rebalancing of external positions in the euro area, because essentially the net debtors saw sharp increases in the level or reductions in the negative side of their current account stock positions, and we, despite the fact that many of them were running deficits, and we don't really have a correction on the side of net creditor countries. So this is in terms of the balance within the euro area. And on the competitiveness side, one thing that concerns us kind of these years, or kind of recently, and I'll talk about it at the very end when I go into the one country that we've selected, is that we had price and cost pressures, which continued to be strong in 2023. Now, we all know inflation has decelerated, and that essentially it's coming sort of close to its medium-term level. But what we've been having in recent years is an increase in labor costs, specifically in 2023. This was there as wages made up some of the losses in purchasing power, and we had an appreciation of nominal effective exchange rates due to currency nominal appreciation. But in some countries, we continue to have unfavorable inflation differentials, and this is something that worries us and leads to an appreciation in kind of real effective exchange rates for these countries. Now, as is often the case, I am running a bit behind time, so I will go through slides that have figures quite quickly and maybe skip a few of them. So this graph here just shows the current account for the euro area according to two measures or two breakdowns, right? So the reason I wanted to kind of show you this a bit is that we had this kind of fall in the euro area current account around kind of 2022. And this has since started to increase and to go back broadly to the level it was before. And I just wanted to highlight this because on the left-hand side, kind of below the x-axis, you can see the kind of dark blue hashed line. And so you can essentially see the impact there of energy goods. And the high increase in energy prices is essentially what has been kind of driving very much the effects on the current account. And on the right hand side, you can see this kind of again under the x-axis, but broken down in terms of price effects and kind of volume. So although higher energy prices continue to have a negative impact on the current account overall, one thing that you can see that is has been happening over time is that the volume of energy broadly that we're importing in the euro area is coming down. So you can see kind of this gradual improvement in that area. Now, I also have some values. I also have the values here for the current account compared with sort of the left-hand bar each time for each country is a sort of pre-pandemic average. And then you can see a sort of the two kind of other colored bars are the 2023 and 2024 current account balance. And all I wanted to show you here is that we have a number of countries for whom there is essentially a deficit that is worse than what was there in the pre-pandemic time. And these are specifically found on, so the graph is split in terms of euro area and non-euro area countries. And the countries that I'm talking about are essentially on the right-hand side of each block of euro area and non-euro area countries. So Slovakia, Estonia, Latvia, Greece, Cyprus, Romania are countries that are, sorry, Romania is not on the right-hand side, are countries where we've had this kind of overall deterioration on external balances compared with the pre-pandemic time, and where we might or might not be worried about this and the kind of sort of dynamics that are there. The final thing, I think, well, I don't know, I can't remember if I've got one or two slides here. Now, inflation is something that has been concerning us and that we've been looking at in this alert mechanism report and in previous years, and we've done some thematic work on the side. Specifically, okay, if you look on the left-hand side, you get a picture of inflation that I think most people are very familiar with, and the way that it's reduced from its peak. It's come essentially nearly down to the kind of level that we had before the pandemic, and where we have now a difference whereby it's core inflation that is sort of persisting and that is higher than HICP inflation. Now, this is important because in some countries, core inflation still remains particularly higher. And that kind of worries us because the mechanism for it coming down is not as clear as for HICP inflation, which has to a large extent been driven by kind of external factors. So the fact that we continue to have a high core in certain countries tells us that there's something internal going on that we really should be looking at. And then specifically, if we look on the right-hand side, we have estimates of the cumulated the cumulated change in price levels over 2019 and 2023, according to whether we measure GDP deflators, headline HICP, or core. And what we can see is that there's very, very big change between kind of the bottom of the distribution and the top of the distribution. Now, clearly, as we look towards the right-hand side, which is countries that have had the most cumulated increases, we see that kind of lower income catching up countries are more affected. But in those countries, we do see kind of specifically very high increases in some cases. They are increases also in core and in GDP deflators. And it's something that we worry about because it's accompanied in some cases with losses in export market shares, and in some cases it's accompanied by continued divergence, i.e. Headline or specifically core inflation that is continuing to be not just higher than the euro area average, but with a bigger difference than in what was the pre-pandemic era. So I mean, although to quantify it, of course, you can't just do it based on charts like these. Nevertheless, it's difficult to think that the kind of differences that we've seen are pure catching up or a pure Balassa-Samuelson or whatever. So there are price and cost pressures going on in these countries, or there were, that clearly are different and that need to worry us. This graph here shows unit labor costs. So all I wanted to show you here is, without looking at the countries and so on, clearly the levels in recent years, so we look at 22, 23, 24, forecast for 25, okay, have been very high. They continue to be very high with different profiles for over different years. So in some cases, we have countries where they had very high increases in wages to begin with, and then maybe less so. Other countries where it took more time, and then to make up for the loss in purchasing power, the pressure came later and wages increased more. But on the right-hand side, what you can see, and I'd like to point you at the yellow lines there, is that some of the impact of kind of high ULC growth has come from negative impacts on productivity. So it's not just a question of prices and costs. Now, other things that we look at and specifically have looked at in the macroeconomic imbalance procedure over the years are debt levels. So we look at corporate debt levels, we look at the household sectors, and what we find is, so on the corporate side, debt to GDP ratios continued last year, as in previous years, to fall, driven by strong denominator effects, but also by a slowdown in lending flows. So debt to GDP ratios overall have reached their lowest levels in a decade. Deleveraging continued in 2024 at a lower pace. And in most EU countries, credit flows have remained subdued kind of even after 2023. And part of that is due to low investment, which hampers demand. So, I mean, interest rates clearly played a role, but also, you know, a demand for investment. Demand for investment has dampened credit demand. On the household side, we see something very similar, which is a reduction in household debt ratios. In 2023, they reached historical lows in most EU countries. Now, the story on credit flows is sort of similar in that they contracted substantially in 2023, despite remaining positive. And this is mainly due to higher borrowing costs. Now, we look at the extent to which they contract and how they change depends on many things, including kind of the precise sort of structure of mortgages in different countries. We expect household debt to continue falling overall, so it was in 24, but at this pace of a reduction of debt for the private sector, we expect it to continue, albeit at a slower pace, and denominator effects are part of the reason for this slowdown. Now, one thing that we've been looking at in recent years is house prices. So house prices had risen very strongly under the pandemic, but with considerable variation. And we saw this kind of moderation in house prices in 2023. In some countries, there was a fall in house prices. In other countries, there was just a lowering of the rate of increase. But one thing that we do expect is a resumption in house price growth, and it's already started, because the underlying fundamentals that have driven house prices to increase sort of over the last decade, and in some cases also in recent years, are still there. So structural effects have not fundamentally changed. And one thing sort of that I wanted to point out was, so on the left-hand side, you can see the changes in house prices in recent years. So they've been, over 10% in some countries, in many cases. And on the right-hand side, what we have is the annual change in house prices on the y-axis, mid-23 to mid-24, against a measure on the x-axis of our measure of over or undervaluation of housing markets kind of at the start of that period, so in 22. So if you look in the kind of lower right-hand side panel, you see that that amongst the most overvalued countries, they're the ones that typically saw strong house price falls. And then the other countries that I wanted to kind of talk about a bit, or to highlight, is that we have some countries, and specifically there, it's kind of Greece, Poland, Bulgaria, Croatia, kind of at the very top of the y-axis, where we essentially never had a substantial slowdown in house prices. So they have been growing in recent years, they continue to grow. These aspects, I mean, clearly worry us, because even though these countries do not appear to be overvalued, there's a dynamism in the housing market. And, again, without going into the economics too much, strong house price growth is something that should worry us from a surveyor's point of view. Of course, depending on the extent of household borrowing, on the health of the banking sector, and so on. Now, finally, on the government side, what we generally see is a reduction in government debt to GDP ratios. Denominator effects have been strong, but now, of course, we expect this to slow down. We've had an increase in the interest burden of government debt, and this is expected to continue to grow because we have the rollover of debt. And that the tailwinds that we've had from favorable differentials between interest rates and nominal GDP growth are expected to vanish. Now, since then, of course, we have the whole discussion about defense spending and so on. I think it's clear that there's a change in appetite for government debt and for financing elements of spending on the government side that maybe we hadn't anticipated 6 months ago. Or finally, we look at the financial sector. I won't go into it in any detail because of time. Our overall finding is that the financial sector has continued to display resilience across the euro area. So there's some graphs here. I won't. I'm over time now. The one country that we found that we wanted to look at in more detail as a result of all this was Estonia. The reason for this is that Estonia has been accumulating cost competitiveness losses. It has had in recent years a deterioration in the current account and continued at the time house price growth. I've got 2 slides on Estonia. So if we look at cost pressures in Estonia, they were and are amongst the highest in the euro area. So accumulated increases were high, but also core inflation in Estonia had and essentially had and has remained strong. So there's a differential there with respect to the euro area that seems to be sort of entrenched. It's not falling. It is maybe not the only country that has sort of this differential, although actually it does stand out. But one thing that is very striking about Estonia is that all this kind of strong price and cost growth that has taken place has occurred despite a very weak performance of the economy. And here it looks very different to maybe some of the other Baltics in terms of this weak performance. And what this it has this current account deficit. Now, I will show you the current account deficit in the next slide. It doesn't look so bad, but because it's happened at a time of very weak demand, there is the worry that if and when kind of growth comes back and demand comes back, we start to see that, in fact, there's an underlying current account that is a lot worse. And then we have this kind of house price growth. So just a few figures. You can see here on the left-hand side, core inflation in blue for the euro area, in grey for all other euro area countries, and then in yellow, Estonia. So there is something happening there where inflation is continuing to grow. You can then see in the middle this kind of collapse in productivity. And finally, on the right-hand side, a current account, which, so if you look at the blue line where we are, it looks clearly worse to the pre-pandemic time. Doesn't look so bad though, right? Current account of 2%, it's not that dramatic, except that when we do a cyclically adjusted estimate, we see an underlying position that's a lot worse. Now, doing cyclically adjusted estimates at this point in time, you can't attach too much certainty to the kind of estimates you're doing, but it does tell us something. And so these are the elements that we will be looking at in the in-depth review of Estonia, which will be published in a couple of months. So I did go over my time, hopefully not by too much, and I look forward to the discussion.
Very much, Christine. Let's now directly turn to Ralf.
Yes, thank you, Ernest. Thanks a lot, Christine, for this very rich presentation, and congratulations to you and the Commission team for this very important report. I think it's very useful to have an annual Commission report that screens EU countries for macroeconomic imbalances. Maybe it's even more important than ever, because the EU economies are affected by a series of very adverse shocks. I mean, starting with the COVID pandemic some years ago, then the energy crisis, now more recently these heightened geopolitical risks and security aspects, which all are global in nature in principle, but of course they have a strong country dimension as well, because they affect EU countries differently, and therefore create the potential for severe macroeconomic imbalances in the European Union. I don't have major disagreements in terms of the overall assessment with conclusions that were just presented by Christine. I think the gravity and evolution of imbalances are very well captured. Let me just focus on a few points from this very comprehensive presentation, which I find particularly important. First of all, as was mentioned by Christine, the inflation differentials have significantly declined. However, the cumulated divergences in inflation in recent years pose a significant risks of entrenched price competitiveness losses, in particular for some smaller EU countries. A second point are increasing concerns about the longer-term growth outlook. This is an aspect which was featured very prominently by Mario Draghi last year in his report on the competitiveness of the EU economy. Keywords are here population aging, climate change, and in several countries also combined with lack of innovation, structural deficiencies, and large dependency on traditional industries such as automobile industry, chemicals, or manufacturing. And this is an aspect which probably affects more the euro area largest economies than some smaller countries. So Mario Draghi looked at this growth and productivity issue from a euro or EU-wide perspective, but of course here also there are significant cross-country divergences which are important, and also in which can build up in the emergence of future imbalances. A third point is that a group of countries which had EU IMF programs during the sovereign debt crisis some years ago, they have performed quite well and remarkably well, I would say, over the course of recent years, despite the adverse shocks. So Greece, Cyprus, Portugal, Ireland, they have performed better in terms of growth and a number of other indicators than many other EU countries. And this is remarkable, because I think if we had this seminar some years ago, probably these countries would have been much more in the spotlight. Now the attention shifts a bit to some other groups of countries. Another very important aspect, of course, that was mentioned by Ernest also in his introductory remarks, the increased geopolitical threats and security risks, which could also further increase imbalances in the future. I think here we all have to build up knowledge on this new dimension of risks to understand better the transmission channels and how this new global map, as President Lagarde pointed or coined it 2 years ago in a speech, how this can be incorporated into the overall risk assessment and such a report. So I think overall it's then key to complement this indicator by indicator approach in the alert mechanism report with more in-depth analysis on determinants of imbalances. And this is then also done, of course, in subsequent parts of the European semester, for example, with the in-depth reviews, which are then published in the spring package. So let me now go a bit more in detail on some of the aspects that Christine mentioned here with this inflation differential story. There, I fully agree. Indeed, I mean, we have seen a decline in inflation differentials since the peak in autumn 2022. However, in cumulative terms, as was mentioned, the divergences inflation are very large. I mean, in Estonia, Latvia, Lithuania, we have inflation rates in cumulative terms since 2019 of 35 to 40 or even above %. So this compares to increases of some 15 to 20% in many other countries. So huge potential for macroeconomic imbalances. In principle, of course, some inflation differentials are normal in a currency union like the euro area. However, if they are persistent and are not related to price level convergence, then they create, of course, the risks for competitiveness losses and external imbalances. And to some extent, we have indeed seen that. Here I show a harmonized competitiveness indicator, a very broad measure of competitiveness for euro area countries. And you see these huge differences in the development since 2019. Again, some smaller countries were particularly affected with a lot of losses. So the positive values indicate losses in price competitiveness, while a few other countries like Ireland, Italy, Cyprus, they have actually gained competitiveness. On this growth story, I mean, this is, I think, a very telling chart which shows European Commission projections over the next 10 years in terms of potential growth until 2033 on average in the blue bars, and the yellow dots show the historical average growth rate in real GDP since 1999. And basically all countries are expected to grow much below the historical average. Actually, the only exception here is Italy, where expectations about an increase in the growth momentum by the Next Generation EU. So Italy, as a main beneficiary of that program, could lead to higher growth. But of course, this is also subject to some uncertainty still. Overall, so the growth differences are also significant. And as you can see here from the countries that I have circled, some mainly larger economies. The four largest economies are more at the right side of this chart: Germany, Italy, France, Spain a bit better. So which illustrates that this growth story is particularly an issue also for the larger Euro area economies. A significant part of this can certainly also be explained by adverse demographics. Mario Draghi in his report last year, he focused a lot on that aspect. So I put here a quote: if the EU were to maintain its average labor productivity growth rate since 2015 of 0.7%, it would only be enough to keep GDP constant until 2050. So these adverse demographics will have a significant impact and really kick in now also in the next years on the growth of the EU economies and create potential for further imbalances. There are, of course, many other aspects like climate change and these geopolitical tensions, which could put further downward downward impact on growth. These aspects are not so much in the focus of the AMR on the growth side, but I think they will feature more prominently than also in the future. And it's of course particularly concerning because in the current environment there are a lot of investment needs in the EU economies stemming from the need to increase defense spending, to accelerate the green transition, to build up infrastructure in both digital and physical in many countries. So the investment needs are huge, and of course this can only be financed then if the growth momentum picks up. Maybe to end with a more positive note, here I show the growth performance of the post-program countries in a long-term perspective since 2003, and you see this strong downturn in the sovereign debt crisis. But then since 2013, these countries have actually grown substantially more than other euro area economies, and not all countries started to grow at the same time. So for Greece it took a bit longer because the problems were more severe, and also because there was a political crisis in 2015 still. But in particular over recent years, I think we can say that the growth performance has been remarkable in these countries. This does not mean that there are no vulnerabilities. So I think there are a lot, but there's at least some evidence that the reforms that have been implemented in these countries during the program times and afterwards have led to some more resilience, and so that these countries were facing these shocks in a better situation than many other countries in the euro area. So challenges remain, obviously, not only for these countries, for many others, to increase growth and strengthen resilience. But I think this report has really highlighted that some progress has also been achieved. Thanks a lot. I leave it with that. And thanks a lot for this very interesting report.
Thank you very much, Ralph. We now turn directly to Sylvain.
Thank you, Ernest. Hello to everyone. Yeah, congratulations first to Christine and the Commission's team involved in this exercise. I mean, the alert mechanism report is a complex exercise that attempts to provide a holistic view of the European economies while maintaining a high level of granularity. So that's sometimes even more complex than ratings are. So kudos. That's difficult. I will not be very original. I have 4 remarks on the work presented. My first remark is about the one-size-fits-all of the IMA exercise. Is it possible? Does the IMR differentiate economies sufficiently? That would be my first point. I will develop the points, but let me just name them first. My second remarks concern the IMR exercise in the new external environment. I think this is a point that Ralph also mentioned. Are macroeconomic imbalances in a fragmented world the same as they are in the global world order? And especially when I look at current account imbalances, for instance. So are the criteria used in this exercise still relevant? Or should the IMR be adapted to it? For instance, you single out Estonia. I think Estonia has been hit by very asymmetric shocks. That might be the reason why it just flagged in your report. I have a third remark concerning a point of methodology in the revised scoreboard, and this is about housing markets. So we'll develop that later. And if I may, I would like to finish on a point that Ernest mentioned at the beginning, quoting Isabel Schnabel about the shift from saving gluts to bond gluts. But let me develop my 4 points, starting with the one-size-fits-all question. So in the literature, the thresholds defined in the scoreboard have often been questioned, especially the asymmetry of the thresholds for the current account or for the unit labor costs. So I understand that the thresholds for government debts are set in stone, given the commitment to the Maastricht Treaty. So we at a rating agency, for instance, do not consider 60% of GDP government debt as a particular threshold, but this is a story for its own. What I want to discuss today is the threshold you have for corporate debt. Why 85% across the board for all countries? So, and your report shows that Eastern European countries are well below these thresholds. So normally everything should be good. But they are below this threshold, maybe because they lack of equity, because there is not much equity markets developed, and then they are constrained in their take-up of debt. So my question here: shouldn't we either be looking at the complex structure of liabilities, for instance, with the ratio of debt to equity, rather than debt to GDP for corporates? So that's my first question. Second point about the IMR in the new environment. So the war in Ukraine has been a very strong asymmetric shock for European countries. And it's clear that the closer they are to the epicenter, the more they have been hit. For example, you report, you mentioned in your report a growing divergence in core CPI levels across EU countries. And when I look at the countries that are singled out, I see that many of them are in Eastern Europe, the Baltic states. And my understanding is that this cumulated increase in inflation in these countries largely reflect second round effects of the initial energy shock. And I mean, it's clear that these countries are more reliant on Russian energy than others. So do you consider the asymmetric nature of these shocks when you propose for an in-depth review of single countries? That would be my second question. Another example is the current account. And you look at the composition of current account balance, trade balance, income balance, which is very good. But shouldn't we pay attention also at the geographical composition of the current account balance in this new fragmented world, both for the trade balance and for the income balance? Today, it seems that a large trade surplus vis-à-vis the US economy is more of a risk, an imbalance maybe, than a trade surplus with Canada, the UK, or any other G7 country. And what about the exposure of the income balance to the US dollar? So with all this discussion going on about Mar-a-Lago Accord and so on, there are many countries in Europe where the investment position is overweighted in US dollar. Is that an imbalance in the current times? So how to take stock of this new world in your RMR exercise? A third point, if I may, on the revision you did for this IMR to the scoreboard. I understood that you changed the reference for the house price index from real price to nominal prices. That makes sense to me, but why not taking the nominal price relative to household income rather than in absolute terms? For instance, in the current housing cycle we have in Europe, you have some countries where house prices have increased strongly in absolute terms, but not in relative terms. And this is exactly the case of Estonia or Croatia, who are flagged in your report for imbalance in the housing prices, while Germany is not. And in these three countries I mentioned, so Croatia, Estonia, Germany, you had a very strong increase in nominal house prices at time of the pandemic. But only in Germany, this strong increase in nominal prices were also an increase relative to households' income. And only in Germany, we have had an housing bubble busting out in the past few years. I'm not sure that there are many imbalances on in terms of housing markets in Croatia or Estonia. So that's my point. And Ernest, let me address your remark, if I may, on Isabel Schnabel's comment from saving gluts to bond gluts. It's clear that public debt cannot be the only game in town to finance all what we have to finance in Europe, to do the climate transition, to increase our defense spending, to rebuild our infrastructure and prepare for the future. There are other ways to finance it. We still have more excess savings, private savings. So Europe should do its homework to use much more efficiently these private savings rather than just take up on public debt. That's clear, and it's about reforms. And as Ralph mentioned, he mentioned the Draghi reform several times. I would also recall an article done by the IMF some months ago, saying that should Europe lower the barriers, the non-tariff barriers it has in the internal single market, it would free up to 7 points of GDP per capita. 7 points. So that would help to cope with aging. That would help to cope with the many challenges we face in Europe. So that's as said, public debt cannot be the only game in town on that. Thank you very much. Turning back to you, Ernest.
Thank you very much, Sylvain. Now, I would suggest, given the time, that I quickly summarize three questions, three very interesting questions that we had in the chat. And then we give Christine and also Ralph and Sylvain a brief opportunity to react on these points. Now, the three questions from the chat, if I may summarize them, are first of all from Gabriela Michailovici from the Central Bank of Romania. She basically asks how to deal with the inflation differentials, given that national central banks cannot directly control supply-side inflation and can also not solve structural problems in the economy. Let me a little bit add on this myself. With inflation differentials, in a world of backward or partly backward-looking inflation expectations, of course, such inflation differentials are not so easy to get away with. They might be perpetuated and continue for longer. Should structural policies step in, and how? The second question is by Anton Moisiev from Tel Aviv University. It is on defense spending, which could add 1 to 1.5% of GDP. Will this, as a spillover, as a side effect, increase productivity in the euro area? How do you estimate the likely negative current account effects and effects on public debt? And what other impacts in terms of imbalances would you expect? And the third question from participants is from Elmar Mangler from the Austrian Finance Ministry. It relates to spillovers from German public spending, from the German public spending package. I mean, we have seen already some effects on yields, on bond yields, not only on Germany, but also on the other country. Is there any first assessment that you might offer? And I see a final question, a fourth question from Franz Nauschnick just now. What will be the growth effects of additional military spending of 1 to 1.5% of GDP? Will it also lower EU capital exports to the United States? So each of you, maybe let's give Christine a little more time, because you also have to comment on the other two comments, and then please, Ralph and Sylvain, your final comments. Christine, you need to unmute.
Okay, fine. Yes. So now the one thing that I'm guaranteed to do is to forget to address some of the issues. I will do my best, but do interrupt me. So I'll try and go kind of reasonably quickly. So in terms of Ralph's presentation, so thank you very much for like focusing on these big issues. Now, one of the central issues that Ralph talked about was kind of low growth. Now, clearly, low growth is a problem when you're indebted, right? So for countries that have high levels of debt, and specifically the countries that we're talking about may have high levels of public debt, but okay, it may not only be that, then low growth is clearly an issue in terms of the ability to pay back debt, and something that we're concerned about. However, we've had quite a lot of discussions over the years since the MIP was put together about what exactly it is that we should be looking at, and what exactly we understand as an imbalance. And specifically, one of the questions that we've talked about a lot is, you know, are you allowed to be poor? And so are you allowed to make the choices that, you know, public policy choices or whatever, that lower your growth and lead to kind of, you know, structurally low potential growth? And the conclusion that we kind of broadly have converged around in DG ECFIN is that the role of the macroeconomic imbalance procedure is essentially to deal with issues that are to do either with the possibility of kind of strong disruptions to your economy, or that can lead to kind of disruptions or undermine the ability of other countries to have kind of healthy economic growth, so spillovers essentially. So in that sense, we haven't taken a view because, or we haven't specifically sought to analyze the sources of low growth when it's just kind of growth in itself. So, I mean, as Ralph knows, like over the years, we've been looking at certain countries, and France is maybe a controversial one in there, but at the moment, for example, we have Italy, where there we're concerned about the fact that there is low growth because of this kind of high indebtedness. Otherwise, I think clearly for our economies and our societies, it's an issue. But somehow within what we try to do, it's maybe kind of not central unless there are these kind of other risks. Maybe what has concerned us a bit more has been, for some countries, not necessarily the like low growth turning into imbalances, but imbalances turning into low growth, and turning into low growth more specifically for the Union and the Euro area as a whole, and that having an impact on other countries. So one of the questions that was raised was about so this was in the chat, about spillovers from German public spending. Now, one thing that those of you who know about the MIP, and those of you with very keen, quick eyes, in the table that I brought up at the beginning, is that one of the countries that has been a feature of our procedure has been Germany, essentially due to the fact that it has had this kind of low demand and the savings investment imbalance, which is reflected in a current account surplus. And there, what we have worried about over time has been this kind of low investment, low consumption, essentially high savings, the impact that can then have on growth, and the impact that has on the ability of the Euro area to rebalance overall. Now, another issue that Ralph brought up was program countries. Kind of, indeed, if you look at the graph that I showed of kind of cumulated inflation increases, you will find the ex-program countries on the left-hand side, meaning that they are amongst the countries that had the lowest accumulated inflation, which has also enabled them to have kind of better outcomes in terms of their cost and price competitiveness recently. And we also see this kind of very high growth for them. So amongst the ex-program countries, Ireland, Portugal, okay, Spain wasn't a kind of normal program. They were countries that were found under our procedure to have imbalances, no longer do. because of kind of this rapid reduction that they've had on their debt stocks on essentially every side. And similarly, Cyprus and Greece, we're still worried about them, but we no longer find them to be kind of excessive. So for sure, one of the big stories has been the success of those countries kind of economically recently. Now, moving on to Sylvain. So you had an issue about kind of one size fits all. Does it differentiate sufficiently? I think, clearly one size fits all and the AMR cannot differentiate sufficiently. So we are to some extent kind of hamstrung by the fact that, we have a regulation that tells us that we need to have a scoreboard of indicators, we need to have thresholds, we need to cover certain areas. And although this is kind of useful for us, we are also, according to the regulation, meant to do an economic reading of it. And that's where we do our best to put kind of all our attention on that. And to take we've done our best to find the most relevant indicators, but to interpret them in a way that is meaningful, and that is meaningful in terms of the current, whatever current is, economic conditions. So essentially, I think and maybe one thing to stress is that we do very much view the alert mechanism report as giving an overall picture, and then we pick out countries, and the country specific aspect comes out in the in-depth review. And I think it's the only way it can be, unless we start doing very in-depth analyses into 27 countries, which is a whole other level of engagement. So it's more a kind of filtering process. Now, what you read in the AMR is kind of the overview and country sections. Sort of behind the scenes, of course, we do more kind of stress testing in that. So one issue, for example, is we chose Estonia. If you look at the kind of the scoreboard, or you look at kind of the bigger pictures, why Estonia and not Lithuania and Latvia? So there we do a lot more analysis to pick out already certain elements that look different, and and that may not be kind of fully quantified across all countries, but we do understand the shortcomings of our process. You brought up the issue of thresholds and kind of specifically corporate debt and so on. Now, the mechanism for doing thresholds, so we have to have the same threshold for all countries, according to our regulation, which is already a bit of an issue, but to some extent maybe convenient for us, because politically it's very difficult for us to, because we are also a political and an international institution. What we actually do, so we choose the thresholds by looking at kind of historical, well, it depends on which one, by looking at historical outcomes and looking at kind of 25th, 75th percentiles, and adjusting as to whether we think there are certain trends that need to be taken into account. But we also have country-specific benchmarks on household debt, on non-financial corporate debt, on current accounts, that attempt to give a kind of country-specific element to them, and which we use in our analysis to also, and it features in the AMR, it features a bit more in the in-depth reviews, to understand the country-specific aspects. And specifically, of course, there are big differences between these newer member states. So we do try to make up for that. We can't do that in terms of the scoreboard overall. You also mentioned the housing market. Now, we had a real housing market indicator, and we moved to a nominal one. Part of the reason for that is that for some countries we saw when inflation was very high, that real house prices didn't really budge very much, and yet nominal were increasing dramatically. When that comes associated with debt levels and when there's a downturn in the housing market, this is particularly kind of worrying. But one of the reasons we wanted nominal is it would give us kind of more flexibility in assessing it against whatever indicator we chose, or whatever metric we chose for inflation or for price increases. So we also have, but without thresholds, auxiliary indicators, and there we have a measure of sort of essentially a price to income ratio, and we take that on board. Now, maybe one of the difficulties is kind of really understanding and finding agreement as to why we're worried about housing. Like, is it a boom? Is it affordability that can lead to growth and so on? But these are all things that we think about, and we do kind of try and make the right comparison, and to some extent moving away from an inbuilt way of deflating the price is partly meant to give us the flexibility to interpret as we think is appropriate. I think there were two more things. Number one was about inflation and the fact that for some of the smaller countries that have inflation, very high inflation, that what we have now is second round effects. And there was a question about whether we take into account the impact of energy. Now, I mean, in theory, the impact of energy shouldn't really be there anymore, at least not in core. What we do is we do take this into account. We do other work apart from the alert mechanism report, and specifically for the in-depth reviews which are coming, we're also doing some work on we're doing what we call a spillover note that looks at the propagation of shocks across countries and so on, and we look at inflation, and we use an input-output methodology. And there, essentially, what we find is that, yes, you know, for some of these countries, it's now wages and profits, and it's not imported inflation particularly, and it's not energy prices. And specifically there in the Baltics, we see differences between different Baltic countries, and specifically Estonia is not a country that particularly was affected by energy costs and imported inflation due to energy costs to the same extent as some other countries. So what we see there, we cannot, according to the methodology that we have and our data, which can't be perfect, be attributed to energy, even kind of the beginning. So we do look at this, and we do intend to publish this work too. Finally, there was a question about kind of I think it was kind of the geopolitical effect and external sector imbalances and so on. I think that it's true that there is a geographical element that short term leaves certain countries more vulnerable than others. But the extent to it, I think, like, we don't really know yet, because it's not just about the geographical composition of bilateral trade flows and so on. It's also more specifically about what these goods are and the extent to which they're substitutable and so on. So to really get an answer, I think, requires a level of analysis that is very, very high. But I think that one of the aspects that we try to focus on is to take a sort of savings investment approach and a demand approach to external imbalances. And so there, I think what we would expect is that, yes, you know, certainly a lot of short-term disruption, but that the underlying fundamentals of like the home economy and the savings investment imbalance that it may have would not necessarily be so affected by external effects, and we would expect a rerouting of bilateral relationships and so on over time. So maybe from a longer term perspective, it's not as important as it appears from a short term perspective. The geographical balance element to income balances is, of course, kind of very difficult and very interesting. Again, we're doing sort of work on this in terms of looking at flows of funds and understanding those. It's way beyond the scope of the alert mechanism report, but not beyond the scope of our normal surveillance, and the fact that this will then kind of feed into our in-depth review analysis. I think I've probably spoken for long enough, other than I haven't dealt with the chat. So one question was how to deal with inflation differentials. I mean, obviously it's not so easy, but I think what we find when we look at in the in-depth reviews, we try to get an understanding of what is it that drives them. And to some extent, sometimes, or in certain countries, I mean, it's very much kind of fiscal, right? So overall fiscal, or the composition of fiscal policy or wage policy, which maybe can't be affected in the private sector, but if it stems from the public sector, there's a capacity of dealing with it. Or in one country, you know, we had a release of kind of pension, accumulated pension rights, which can lead to inflation and so on. So there are means, obviously much easier if you can just adjust your interest rate. For defense spending, I think it's too early to answer on that, but I think if it leads to more investment and it leads to a kind of like bigger demand in Europe, we would expect that to have some, don't know how many, positive impacts economically, specifically also for, and also specifically to have positive spillovers across the EU from higher German demand, whether it's investment or whether it is from a higher consumption spending, which we can expect to spill over into other countries. Apologies for talking so long.
Thank you very much, Christine, for taking these questions so seriously and for helping us with the answers. Really appreciate it. I now want to give Ralph and Sylvain the opportunity for short final comments. Ralph?
Thanks. I will try to be brief. Maybe have 3 points, starting with inflation, because it's also, of course, closest to central bankers. I very much agree with the statement by Gabriela in the chat here. The situation has become more complex. I mean, for a large period, we're mostly dealing with deflationary shocks. Right now, the situation has become two-sided. Aging and also digitalization are probably still deflationary. But then there are these increased pressure for defense spending and trade-related fragmentation issues, which can have both effects, right? They can increase inflation or decrease when you have more defense spending and more rebalancing from foreign demand to domestic demand. Then, in particular, in a capacity constrained sector, you may have higher prices. But at the same time, of course, it could also be that there's some lower demand for EU exports, or also a redirection of trade from the US to Europe. For example, Chinese export could then increase to Europe. So this could also lower prices. Right? It's difficult to say. I think there was also a speech last week, the ECB president, she said the trouble with our times is that the future is not what it used to be. So we have to basically then adjust to these new circumstances. But I agree also, of course, it's very important for central banks, because it can indeed have a significant impact on the transmission of monetary policy and on the smooth functioning of the euro area. Quickly on the second point, on this very good remarks from Sylvain, I would really subscribe here also this call for more ambitious structural policies. I think this is really key. There's also a comment in the chat from Jan on whether we should compare maybe also to countries outside the EU. I think when we look at global benchmark indicators from the OECD, then we really see that there's a lot of scope for EU economies to improve, this has a lot to do with national policies. I mean, of course, there are European initiatives which are really important, like the Capital Markets Union, Banking Union, further deepening of the single market. But structural policies also have a lot to do with national policies, sometimes even subnational policies. When you look at surveys from the EIB, for example, you really see also complaints about high regulatory burden and large planning and approval procedures, which hinder, of course, and also the efficient allocation of resources and have a downward impact on growth. And so it will be very important to address these aspects in a more forceful way in the future. And the third point on defense spending, on the impact, indeed, I agree, of course, it will have important impact on public finances, given the amounts that are involved here. I mean, even because if you take it out from the Stability and Growth Pact, then for the market, I mean, this is overall that numbers still count, right? So they don't differentiate between defense spending and non-defense spending. So we have to be vigilant then about debt sustainability risks. Productivity effects, yes. I mean, of course, this is not the primary objective of defense spending. And I understand from the literature that there are also very different conclusions on that. A lot, I think, will depend on how much Europe will import, right? Whether we can build up a stronger sector here in terms of military equipment, that we can reduce our dependencies here also. This could, of course, then have, if a lot is shifted to Europe, this could, of course, then have positive growth impacts. I mean, that was extremely interesting. I would have a lot more to say, but I think I'll leave it with that, given the time constraints. Thanks a lot.
Thank you very much, Ralph. Final word to Sylvain.
Yeah, thank you, Ernest. Yeah, we should have planned 2 hours for this conversation. And thank you very much, Christine, for the very comprehensive answers to my questions. So besides the fact I would, like Christine Lagarde, encourage everyone to read Paul Valéry in the French version, of course. Let me address briefly 2 questions from the chat you mentioned, Ernest. The first one on how to deal with inflation differential, and the other one on the spillovers from all this defense spending and German stimulus on the European economy. On the first question on inflation, I would take it differently. Because it's clear that when you have an asymmetric inflation shock, that's the answer should be that of subsidiarity. It's for the regional fiscal authority to deal with it. But we should have had to deal with asymmetric inflation shocks and high differential within the European Union if we have had a unified market for energy and energy grid. So the reason for this inflation differential is a fragmented energy market in Europe. So the answer is, the long-term answer is structural reform, deepen the single market, do the energy market union. On the spillovers of this fiscal spending, I mean, there is a price to pay for the fact that Europe has saved a lot of money on defense and other things. If you look at Germany, also on infrastructure for decades. And maybe the growth effect will not be large because imports from weapons and ammunition will be important. So there might be also negative spillover on current accounts, but that's not important. What is important, besides the fact that we are fighting for our liberty and the way we live, the aim of all this spending is to increase the capital stock, the capital stock of weapons, so the military capital stock, the capital stock of public infrastructures, and also the stock of skills to reindustrialize our economies. That's what matters. And if the cost to pay is a few basis points on long-term yields, a bit less current account surplus, I think it's a fair price to pay. Thank you.
Thank you very much. This concludes today's SUERF-Baffi Bocconi e-lecture on challenges from low growth and diverging price and cost developments, key takeaways from the EC's 2025 Alert Mechanism Report. Thank you very, very much to Christine, Ralph, and Sylvain for your excellent presentations and comments and for the very vivid discussion. And to all participants for your interest and for the very relevant questions and comments. Sorry for overdrawing time a bit, but I think the interesting discussion was definitely worth it. Thank you very much. Bye-bye and take care.
Thank you.
Bye-bye.
Bye-bye.
Thank you very much.
Thank you.